Welcome to Founders Future, a podcast powered by Closers.io, where we dive into the journeys of innovative entrepreneurs and explore the road ahead for them and their companies. I'm your host, Ammar, and in each episode, we uncover the stories behind impactful ventures, the challenges faced along the way, and the strategies driving their future growth. Today, we are absolutely thrilled to be joined by Matt McCabe, the managing partner and co-founder at Axia Growth Partners. Matt brings over 2 decades of experience in private equity and operational leadership, having worked with high-growth SaaS, tech-enabled services, and manufacturing companies. At Axia, he and his team partner work with ambitious founders to scale value creation with a unique hands-on model that blends capital, operational expertise, and data-driven strategy. Matt, welcome to Founders Future.
Thanks very much, Ammar. I'm thrilled to be here.
I'm excited to dive in. I always like to start from the beginning. So can you take us on a little trip down memory lane to before you started Axia Growth Partners? What were you doing at the time? And then what was really the motivation behind starting the company?
Great. Yeah, great questions. I started this journey thinking about doing a search fund, right, to acquire and operate a business, probably the second year of my MBA, which was 2017 to 2018. I really like the model. I really like the idea of going back to a smaller regional business, right, where there's a lot of upside, but there's also a lot of kind of simple fixes you can make. And it's really about leadership and more so than it is about any kind of working capital management or corporate strategy or any of this kind of stuff, right? So that always appealed to me because I come from a family of entrepreneurs. And really, what I felt like I needed to do after the MBA was get a little bit more well rounded experience, which is the reason that I went to management consulting and worked for an operations focused consulting firm. And over the course of the 7 years I was working there, I built up confidence seeing a lot of different types of financial, operational, manufacturing, engineering problems, and really just used that period of 7 years to build up my confidence that
Mm.
I was eventually at the point where I was ready. I felt like I had enough exposure to different parts of a business. And pairing that 7 years of experience with the 7 or 8 years prior, which was mainly in sales and business development, I said, okay, I feel like I still want to do this with a partner, right? Somebody who understands a little bit more of the structural finance aspect and legal aspects of doing M&A, because that's something you don't want to get wrong.
Yeah,
And so the
kind of
the
a big
real
deal.
exactly, yeah. So the trigger of that was me effectively finding who that partner was going to be. Somebody that had actually been a friend of mine, but kind of for whatever reason, their timeline converged with mine. And we talked about it for 5 or 6 months, and finally said, "Hey, man, it seems like you want to do the same thing I do. It seems like we have similar areas of interest." And so it was part, I would say, preparation and long-term planning, and part serendipity that I just happened to find the right person at the right time. And that gave me the confidence to use my experience, my partnership with my partner. And then I think the opportunity is ripe for it as well, just because search funds are becoming a little bit more well organized, and investors are also becoming a little bit more comfortable with investing in that model.
Interesting. I have one more question before we dive into exactly what Axia Growth Partners is. I'm super curious.
Mhm.
When you first got into management consulting, did you always know that this was what you ultimately wanted to do? And that was the plan all along? Or did it evolve into that? And if it was the plan from day one, I'm curious how you had so much clarity early on in your career.
Yeah, yeah, great question. I still think I'm in a position where I still don't quite know what I want to be when I grow up, but I think everybody should have a 3 to 5 year plan in
Yeah.
terms of ideally based on what you know today and based on what gets you excited and gets you motivated to get up and get out of bed in the morning. What does the next 3 to 5 years look like for you? And for me, that was always doing the search fund thing. And over the course of those 6 or 7 years out of the MBA, I saw other friends have success with that model. So it continued to push me in that direction. So I would say, to answer your first question, yes, I knew that I wanted that to be my ultimate path. But I think it even got delayed a little bit working in management consulting, just because you always say, you never feel financially ready to start your own business.
Yeah.
And so I think that's a key recurring theme that I hear from a lot of my friends who are founders is you have this nice cushy corporate job. I'm not going to get into how much consultants get paid, right? But it's a big enough difference when you compare whatever you're getting paid in consulting versus zero, at least for a year.
Yeah.
And so, yeah, and so I think that's a leap that a lot of people have a hard time getting their head around. But for me, fortunately, I have a wife as well that is a very smart, qualified professional. And so where we were at in our life, the serendipity of meeting my partner at the right time, it all just lined up, and I just needed to kick myself out of the nest, right?
That's awesome. That's awesome. It's beautiful when, what is that? The eclipse when the moon is in front of the sun and it's like the
That's
perfect,
it.
all that stuff.
That's it.
But I'm super curious for the audience that doesn't know anything about search funds. Can
Mhm.
you explain to us what that is and explain to us at Axia Growth Partners, what is your focus in terms of what companies are you looking to acquire and then take the conversation from there?
Sure. Yeah, so a search fund, the reason it's titled a search fund is because a good portion of the effort is simply searching for the right business for you to acquire. Okay, so that's where the name actually comes from. In practice, what does a search fund do? There's 4 or 5 steps, depending on how you count them. So, one is what kind of business do I want to acquire? So, in which industry? And very often that criteria plays itself out in terms of, okay, where do you have experience or where is your skill set transferable to? In terms of how you deliver value to customers, what kind of suppliers you work with, right? There should be some kind of story in terms of how you've been exposed or experienced in that particular industry. The second one that you develop is your size, right? So, how much can I afford to pay for these businesses based on my own personal asset and how much a bank will give me or how much money I can raise from investors? And then the third criteria is where do I want to go? A lot of search funders, let's say, are much younger than I am. And so they say, I'm willing to go anywhere in the US, sometimes Canada, sometimes Mexico, because I don't have a family, I don't have any kids, I'm much more mobile. And so that's the third criteria that you use, that once you get those 3 points aligned, you're ready to go out and execute a search fund. So, step one, you've defined those 3 things, right? Your size, your geography, what type of business you want to buy. Second, you get out there and you just try to generate deal flow, right? So, you have business brokers, you can reach directly out to businesses, and you really just try to talk to as many people as you possibly can that are either business owners, advisors that are on the sell side advisory for people looking to sell their business, or industry experts. So, a good example of that is yesterday, I was actually talking to my cousin who works in a very similar adjacent industry who does staffing for
Hmm.
engineering services, right? So, I talked to him, see who was in his network and everything. And really, you're just trying to catch up with old contacts, tell everybody what you're trying to do, and say, hey, if you know anyone, please send them my way. And then once you actually find a target company, you start making offers for that company. Okay. And usually that's where the real challenge comes in, because every business
Yeah,
owner thinks their business is worth $100 million and you think it's worth
I know.
10.
Yeah.
And so it's a very tricky process because you're competing against private equity, corporate buyers, and so on. And then, the other buyers, Matt McCabe. Okay. And then once you actually successfully make your first acquisition, it's all about value creation, right? So you're trying to operate the business, improve it, probably grow top line, improve margins, and make sure that people don't want to leave the company, retain the key employees. And then ultimately, most people have somewhere between a 7 to 10 year timeline where they would look then to exit the business or sell it for a profit. And our timeline, I would say, is probably between the 8 to 12 year range, right? As long as we're creating value and growing the company, and it makes sense for investors and the bank gets paid back, then we're willing to stay in it for a fairly long term period. So that's a search fund model. If you look at the economics of it, it's very often structured like your classic private equity, but people have little nuances in terms of the way the comp structure works and stuff like that.
What do you mean by that last part? The comp structure, the economics. Like one thing that I'm curious about, first off, I was taking vigorous notes when you were saying that. While you're searching for the business, obviously I can imagine that can take quite a while. How
Yeah,
does the business generate revenue in the meantime? Is it from capital that you've raised and it keeps the lights on? What does that actually?
great question. Great. No, great question, Ammar. So there's two classic models for search fund. There's what they call traditional search funds,
Okay.
and there's our model, which is the self-funded model. Okay.
Mm,
Those are the two that I would say cover 95% of search funds. Okay. The traditional model is very often used by recent MBA graduates. So people coming out of their graduate business school programs, and
okay.
they would actually raise money from investors to fund their search process.
Mm,
So in a typical scenario, you'd raise money from 10 to 15 wealthy individuals. probably to the tune of, let's say, $20,000 each, and you're using that $200,000 to $300,000 to pay yourself a small salary, to fund all your travel expenses, to ultimately pay for deal fees, right? To accountants, to lawyers that need to help you do due diligence, and also some systems, right? Everybody has their different technology stack in terms of what CRM they want to use or what kind of deal flow funnels they want to use. And there's tons of them out there we can talk about later. But that I would say is the more common model. Okay. And really what you're giving is yourself is a little bit of cash runway to basically last for 2 years to pay yourself small salary, all your systems, et cetera, travel. The other alternative to that is what we're doing, which is a self-funded search. And that is a little bit more common of people that are mid-career professionals, right? So I myself, I'm 37 years old. My partner is 35 years old. Just by virtue of us having been out of business school, having worked more years, been very frugal with our investments and the way that we save money, we effectively are financing all those expenses out of pockets. And what that really means in terms of what it changes for your outcome is 90% of the time, a self-funded searcher is going to own somewhere between 65 and 75% of the business they acquire.
Mm.
On the traditional side, you're going to have an 8 1/3, 8 1/3, 8 1/3 model. So the investors are going to award you 8.33% for having successfully acquired a business.
Yeah.
Okay. So you roll into the business with 8 1/3 ownership. You get another 8.33% for linear performance goals, right?
Okay.
Over time. So let's say that's tied to EBITDA, it's tied to top line revenue. You can earn in to that 8.33%.
Mm-hmm.
The final 8.33% is more or less guaranteed as long as you can successfully exit the business and make a sale, right? As long as you make the sale, you get the final 8 1/3%. And so best case outcome is you're going to be awarded for 25% of the total value of the business that you ultimately sell, right? Ours is not really standardized. You can agree performance goals with the investors, but really we're in the driver's seat and we're more in a position of control where we propose the structure. We go back to the investors, and very often they're going to say, we're not happy with that structure, but at least we can start from the starting point of walking away with 70% of our first acquisition and then horse trading from there, let's say.
Powerful. Okay, so really the biggest difference is that you're self-funding the search process, your living expenses, and then
Mm-hmm.
once you find the deal, that's when the investors are coming in. So there's no risk on their part
Yep.
until you
No,
find the deal. Then that's where an element of risk comes in.
you hit it right on the head. It's basically those investors, the reason that economics are better for them in traditional is because they're taking on a lot more risk, right? They're giving you money that you might throw down the drain. You might never find a company, right?
Yeah.
They still get first right of refusal when you actually do market a deal to them, but we're taking all of the risk. And we also have the risk that investors they don't necessarily have skin in the game like a traditional search fund yet, right?
Yeah.
So they don't really owe you even a phone call.
Yeah.
You have to get them on the phone and you have to try to raise money from 8 to 10 people when the deal is live.
So interesting. So let's talk about the deal origination process when you're looking to source these types of businesses. First off, at Axia Growth Partners, I know you guys are in the middle of something right now. I don't know how
Mm-hmm.
much you're willing to divulge in terms of details and whatnot, just whatever you're comfortable with. But I would
Sure.
love to know what kind of businesses are you guys looking for? And then how do you fill the pipeline?
Great question. Great question. Yeah, we have a couple of investment theses, right? And I'm willing to go into a little bit of detail about them. I don't think there's any trade secrets necessarily, right? The area that we like the most is what we're titling energy supply chain. Energy supply chain, we think, is really promising just because the overall tailwinds behind AI and data center development and so on, that's going to create a huge burden on the utility grid for the United States. At the same time, you have a big push towards electrification of the grid. Whether or not whichever administration is in the White House at any particular time, you could argue whether or not renewables are going to make up a bigger part of the mix. But regardless, there needs to be a lot of work around the actual US utility electricity grid, right? So we're targeting companies that are either suppliers and manufacturers of kind of critical components. So good
Mhm.
examples of that could be like components that you need to regularly replace in transformers or generators, or the companies that actually do the service of that, right? So maintenance of those critical pieces of assets, right? The other big tailwind that we like there is there's a big labor shortage in the engineering and trades, the kind of skilled trades related to these. So we think that if we can solve that labor issue and take advantage of the whole concept of a rising tide will lift all boats, right? In terms of there being some good tailwinds for this industry, then we think there's a lot of little niche players out there that are going to just naturally grow with the market. Okay. We like some other spaces like fire protection. There's another niche industry called testing, inspection, certification, control, or TIC, as it's lovingly known in the private equity world. So those are some areas that we're looking at right now. And really the way that we're trying to generate deal flow, there's two channels traditionally.
Okay.
There's on market, and that basically means think of a real estate agent, right? You can go on a real estate agent's website, or you can go on Zillow and you can look at all the business, or excuse me, all the home listings available that are
Yep.
available for sale. There's also a world out there, an industry of business brokers that are effectively similar to real estate agents, but their job's a lot more complex because they're selling big businesses instead of homes. Okay.
Yeah.
And there's a lot of different directions it can go. It's not a standard 30-year fixed mortgage rate, all that kind of stuff. So there's a lot of changing parts, right? And moving parts that have to come together for these business transactions to be successful. Okay. So I would say we tried to automate as much as our deal flow as possible through brokerages. So you
Got
can
it.
go on to their websites and you can say, hey, here's my email, here's my criteria. I want you to send me all the new listings that fit that criteria every Monday morning, and it comes direct to your inbox. In addition to that, there's aggregator platforms. So a couple common ones would be, I'll give a plug to one of our search fund coalition partners, which is KUMO. They do a really good job of aggregating deals from several different platforms. There's another big one out there called Axial, not to be confused with Axia. It's basically our name with an L on the end. And so these are basically the same thing. They just have a lot more filters and they have a lot more deal flow through them because brokers from specific business brokerages are posting their deals on these platforms to market the deal to a wider audience. Okay.
Got it.
So that's the on market platform, right? So you go in, you set all your filters, you try to automate as much of that to your inbox. If you like the listing and you like the teaser description of the business, you pursue those opportunities, you sign an NDA, and then they send you some financial information and what they call a confidential info memo. Okay.
Yep.
So it's like a 20-page packet about the business. On the off market side, essentially what you're doing is cold outreach. So that would
Yeah.
be similar to a lot of your other guests that you've had where they're running SaaS companies or they're
Yeah.
really trying to do B2B, true classic B2B sales, right? So you're trying to find who the person is that you need to get in contact with at that organization. And you're trying to be a little bit discerning about, do I want to go after this company just because it's in my industry and I'm just going to blast kind of an anonymous email out to them?
Yeah.
Or can I tell how old the owner is and how long they've been running the company as a proxy for whether or not they'd be more willing to talk to me? If they're in their 60s, you touch base 50% of the time they'll be handing it over to their kids. 50% of the time they'll say, make me an offer. How much would you offer for the business? So these are the two most common ones. And I would just say most people acquire through what we call on market through these brokerages, just because if you think about it, if a business owner has already gone through several steps to put together this info packet with a broker and actually go to market with their deal, they tend to be a lot more serious.
Yeah.
Whereas if you're going off market to somebody, it might be the first time they ever thought about selling their business. So you have to say, hey, can I come visit you? Can I download the information in your QuickBooks? Are you willing to sign a mutual NDA? Just a little bit more friction involved in the process and
I'm
tends to flow
sure.
more slowly.
I can imagine that it takes the sales cycle, I guess maybe that's not the right word. It takes a lot longer in terms
Yes,
of actually being able to get to an offer and then an acquisition as well.
absolutely. Absolutely.
With the company that you're looking at right now, was that on market or was that off market?
Yeah, I forgot to answer your question about the one we have underway right now. Yeah, it was actually on market.
Cool.
It was marketed by a brokerage called Crossroad Advisors, and I'll give them a plug as well because the broker over there has been fantastic to work with. We found the deal in early May and taking you through the process because it's fairly representative of how these on market deals go. We signed the NDA And I always like to call the broker. Some buyers out themselves as not serious, just data collection bins because they're trying to get a bunch of information and who knows what they do with it, right? We sign the NDA and we say, hey, we like this business. We're ready to move quickly, at least give you a yes or no answer, whether or not we'd actually like to make an offer. And we'll do that within 1 week. And straight away, I've told them, I'm serious. I'm going to move quickly. I'm efficient and I'm not going to BS you. Okay. And it qualifies you as somebody who's serious and who's in the market and really ready to make a transaction happen. From there, we had a call set up after we'd analyzed the deal. We said, we're very interested. Can we talk to the ownership team? He set up a 1 hour call with the owner and his wife. We had some really good discussions, asked them questions about trends in revenue, where they see the market going, a little bit about personnel and the key positions as they see it, who are the people that we want to make sure we retain. And then really what you're trying to figure out, at least what I'm trying to figure out, is what is the seller's goal? Does he just want a big paycheck, right? Or does he want to make sure that he's handing over his business and employees, by the way? Does he want to make sure that those people are well cared for and they're not just going to fall into the hand of a corporate buyer? Because there's a reason these people are working in small businesses, right? It's because they don't want the bureaucracy of a huge corporate, right? So it's really important to figure out what the goals are. In this case, the owner, his goal, which we thought was very interesting and made us decide to move really quickly, is he actually wanted to only sell 80% of the business. And his reason was, and all his communication since then has very much aligned with this, is I've taken this business to about $10.5 million top line revenue. I don't know how to grow it further from here. I don't know how to scale the business. It's taking me a ton of time because he's also involved in some of the processes. And he needs somebody that has scaled businesses before and is familiar with his market. And so fortunately, both of us, both my partner and I, were able to show a true kind of trajectory in terms of how our skill sets could not only complement the business and one another, but how it was applicable to his industry. And we even knew some of the players that he was working with before. So that was a really good fortunate circumstance for us.
Cool.
We decided to make an offer. So we wrote a letter of intent to explain what our valuation was, explain what the rationale behind the valuation was, and the general structure in terms of how much was going to be bank debt, how much equity we were going to raise, and what our kind of 3 to 4 year plan was for the business. And I think we went the extra mile and qualified ourselves to get through to where we are now, which is final two buyers, starting from 8 to 10. We got to the final round of 2 because we actually put quite a lot of legwork into trying to give him visibility and transparency in terms of what we saw as a coherent 3 to 5 year business plan, because that guy's leaving 20% of the business. We want him to know that we've got a plan to grow it, and he's maybe going to get a little bit cheaper offer from us up front, but he can make that back twofold based on our value creation plan.
Boom. That's powerful. That is so interesting. I guess when you think of and real quick, because I know we got to go, when you think of your ultimate vision, let's say over the next 8 to 12 years, because I know that's your timeline, are you looking to just acquire, let's say this deal goes through, are you looking to just acquire this one, focus on this one, and then not really try to bring any other businesses on? Or do you have a cadence of we want to buy one business every 2 years, 3 years, something like that?
Yeah, great question. The direct and honest answer is I don't know.
Fair.
I know what I want to happen. And what I would like to happen is we buy this business, we grow the top line 6 to 8, maybe 10% a year, as it has done for the last 4 or 5 years. And then bolt on other companies, I would say starting in year 2 or 3. It's really important that we get in there, learn the business, learn actually what the strategy is, as if this business was going to be the only one we ever owned. And treat it as if that's the platform that that's our company that we want to take to the next stratosphere.
Yeah.
However, as many people know from private equity case studies and all this other kind of stuff, there likely will be subsequent acquisitions that happen after that. And I envision in the best case scenario, starting maybe beginning of year 3, we try to make one acquisition every year or every other year. Okay. And do that in a very coherent, careful way, because if you end up acquiring a conglomerate of all these different Frankenstein businesses that don't complement one another, then you can actually dilute value as opposed to creating value, right? So you got to think about, okay, what end markets could the capabilities of this business also cross-sell to? Am I buying a business in a different region where this business doesn't do a lot of work right now and they're very similar in the way that they work, and we can take the best pieces of each one and merge them together? So that's really where a lot of value creation comes into play. And I think that we're open to both models, but we would definitely prefer to make subsequent acquisitions and have a coherent kind of roll up play involved.
Matt, this has been a super, super interesting conversation. Thank you so much for your time.
No, my pleasure, Ammar, and I hope you found value in it. And it was a pleasure to talk with you as well, man. Great questions.
100%. What is the best way for people to reach out to you?
You can reach out to me on LinkedIn. On LinkedIn, my full name is Matthew McCabe. You should be able to find me as the co-founder of Axia Growth Partners. If you want to reach out to me via email, please use my personal email. It's matt.mccabe11@gmail.com. And if you want to post that in the notes of the show as well, Mark, feel free to do so.
Awesome. Beautiful. So that wraps up another inspiring episode of Founders Future. To our listeners, if you enjoyed this episode, don't forget to reach out to Matt. Tell him this was awesome. I personally love this a lot. Now, if you're inspired by today's conversation, don't forget to subscribe wherever you listen to your favorite podcasts. And if you're a business owner and you're looking to scale your business and really enhance your sales and marketing efforts, visit closers.io to discover how we can support your growth journey. Until then, keep on climbing.